Bismillahirrahmanirrahim. Subject is financial management. This is seventh online lecture. Today we will discuss estimation of cash flow. In today's lecture we will discuss what is depreciable basis for the capital assets, disposal of capital asset or depreciable assets, calculating incremental cash flow on the project, how to calculate initial cash flow of the projects, how to calculate incremental cash flow of the project for each year. Then if the project is, let's suppose, of 10 year, on the last year, that is called the 10th year will be called terminal year, how to calculate the cash flow on last or terminal year, incremental cash flow on last and terminal year, because there are some certain costs which are to be reduced or which are to be included in the last year incremental cash flow. And finally we will discuss one example on incremental cash flow. So moving further, what is depreciable assets? Depreciable assets are depreciable basis in tax accounting. Fully installed cost of asset is called depreciable asset. This is the amount that by law may be written off over a time for the tax purposes. By law means income tax ordinance in Pakistan. If income tax ordinance allowed you that on any specific asset that much amount can be accepted as depreciable asset, it will called depreciable basis. Now depreciable basis can be expressed in equation as cost of the assets. If a firm purchase an assets on, let's suppose, 10 million, that is what they will pay to the vendor. It is called cost of the asset. Now what are capitalized expenditure? Capitalized expenditure means this asset will bear transportation cost. This asset will need installation and also involve of cost. This assets may require other things like other equipment will be needed. It will also be included in this depreciable basis. So capitalized expenditures will also be included in the depreciable asset. What is capitalized expenditure? Capitalized expenditures are expenditures that may provide benefit into the future and therefore are treated as capital outlays and not as expenses of the period in which they were incurred. Any installation cost on that assets will provide a benefit as long as this asset exists. This transportation cost will also be included in the depreciable basis because these are not incurred for earning the revenue. It is incurred to install the capital assets. So example of capital expenditure are shipping and installation. These are two costs which will be included in the cost of the assets. So all these three will provide you a depreciable basis. Capital expenditure are basically that are incurred and whose benefit can be enjoyed for more than one accounting period. We call it capitalized expenditure. Revenue expenditure are those expenditures whose benefits are enjoyed for that specific accounting period, which is called revenue expenditure. Moving further, sale or disposal of a depreciable assets or capital assets. So generally sale of capital asset generate capital gain. are capital losses. How capital gain can be calculated? If, let's suppose, book value of the company is 100,000, this is book value. What is book value? Book value means cost of the assets minus depreciation, accumulated depreciation. It is called book value. If this is book value and it is sold for 150,000, so it will gain, that's called 50,000 is capital gain. 50,000 is capital gain. If it is sold for, let's suppose, 70,000, this 100,000 book value, we will call this 30,000 capital losses. So asset sale for more than book value is called capital gain. Asset sale for less than book value is called capital loss. Historically, capital gain income has received more favorable US tax treatment than operating income. So capital gain is also taxable in United States. But what about the capital losses? The capital losses are adjusted against capital gain. If you have three assets, one gave you, let's suppose, 50,000 capital gain, and other gave you incurred losses of 30,000. So these will be adjusted with one another if these are, let's suppose, two assets. So currently capital gain or tax in ordinary income tax rate for corporation maximum of 35%, that is US tax rates. What is capital losses? Capital losses are deductible only against capital losses. You cannot claim tax return on capital losses. You will adjust these capital losses against capital gain. Now calculated incremental cash flow. We will calculate, we will divide the whole process in three phases. One is initial cash outflow. When the company purchase or acquired any capital asset, either it is building or it is machinery, the company will incur certain cost initially. Means it will pay the cost of the assets, it will pay installation charges, there may be increase in working capital for that specific machinery. So all these will be included as initial net investment, which is called normally denoted as ICO, initial cash outflow. Second is, for each year, if the asset have life for more than one accounting period, let's suppose a 5-year project. So 1, 2, 3, 4, and 5. We will calculate incremental cash flow. We will calculate this ICO at 0, means initial cash outflow. Then incremental for incremental net cash flow because of that specific capital asset at the end of year 1 and at the end of year 2, and so on for 3 and 4. But what about the fifth one? Fifth one need specific treatment because that is a terminal year. So terminal year incremental net cash flow, final period net cash flow will be calculated. So there are 3 phases in this project, that is initial ICO calculation, Then for these 4-year incremental cash flow calculation, and this for the final year terminal cash flow calculation. Now we are going to discuss these one by one. Initial cash outflow. First, we will include net cost of the new assets. Cost of new assets means the company purchase a new asset. First, it will include that cost. This is first thing in initial cash outflow. If there are any capitalized expenditure, as discussed earlier in this lecture, that these may be shipping cost, shipping charges, or these may be installation charges. So it will also be included in this cost of the. These will be included in this asset, cost of the asset. Because of this new project, there may be increase or decrease in net working capital. If it is increases, it will be added to the cost of initial of asset. If it is decrease, it will be deducted from that cost of the assets. If this asset is replaced with the old one, so if any proceeds will be deducted from this new cost of the new assets. If there is any tax saving, it will also be deducted from the cost of new assets. So if there is increase in the taxes, it will be added to the cost of the new assets. So this whole thing will give us initial cash outflow. We will discuss it with the help of example in the coming slides. Moving further, incremental cash flow. When we buy any machinery or any equipment, it will increase in revenue. Along with this increase in revenue, it will also increase in cost. So revenue minus expenses will give us net revenue increase. Net revenue. Then, because of this new asset, there will be increase or decrease in depreciation. If there is increase in depreciation, it will be deducted. If there is decrease in depreciation, it will be added. Net changes in income before tax, that will give you this amount. Now, because of this whole calculation, either tax will be increases or decreases. If the tax increases, it will be added. It will be deducted. If it is decreases, it will be added to the net income before taxes. So net changes in the income after taxes, this is income. Now we will add back that depreciation again, because it is non-cash item, so it will give us incremental cash flow. We will also discuss it with the help of example in the coming slides. But again, there are 3 steps. First, calculate net increase in operating revenue minus net increase in operating expenses because of this new project. Then, if there is increase in depreciation, deduct depreciation. We will get a net income before taxes. We will calculate taxes on that net income, and then we will add back after tax. We will get a after tax profit. Then we will add back depreciation in this after tax profit. We will get incremental net cash flow for the period. Now terminal cash flow. Incremental cash flow for the last year. First we will get this figure. Then if there is any salvage value of this machine, we will add to this terminal value, incremental cash flow. If there is increase in tax, we will deduct it. If there is any decrease in working capital, we will also add back. If increase, we will deduct it. So it will give us a net terminal year incremental net cash flow. Examples. With the help of this example, we will move further and will discuss all three phases of the project: calculating initial cash outflow, incremental cash flow, and terminal cash flow. Basket vendor is considering to purchase a new basket weaving machine. The machine will cost $50,000. That is cost of the asset. First variable plus 20,000 is shipping expenses. This is called a capitalized expenditure. Shipping and installation, and fall under 3-year makers. So we will use depreciation table and make us 3-year property class. That is, in first year we will charge 33.33% depreciation. Net working capital will raise by $5,000. Increase in net working capital, it will be added to initial cash flow. Lisa Miller forecast the revenue will increase by $110,000. So because of this new weaving machine, the company will earn more, earn $110,000 more for each of the next year, and will then sold the scrap, that is salvage value of this machine after at the end of the 4th year. This asset have life of 4 years. When the project ends, operating cost will rise by $70,000. So that is operating cost increases, that is operating revenue. So net revenue will be $40,000 because on 10 and $70,000. Now basket vendor is in the 40% tax bracket. So tax rate is 40%. Moving further, we'll calculate initial cash outflow. First of all, what we will do, cost of machine 50,000 A. Shipping and installation means capitalized expenditure, that is 20,000. Increase in working capital will be added, that is 5,000. No replacement cost of the old machine, no replacement cost of the salvage value as well. So 50,000 plus 20,000 plus 5,000, 75,000 is your initial cash outflow, ICO. Cost of machine, capitalized expenditure, increase in net working capital. Now moving further, what is incremental cash flow? Discuss it stepwise. In first year we will earn 110,000 revenue, and because of this weaving machine 70,000 operating expenses will be increased. Net 40,000 will be net revenue for this from this machine. So 40,000, 40,000 and 40,000 for all 4 years. That is incremental revenue the company has experienced each year. Now depreciation. For the first year it is 33.3% on 75,000. 75,000 is the cost of machine. So we will calculate our depreciation on 3-year property class by this rate. So first year depreciation is this 23,331. Second year is this, third year is this, and fourth year is this. That is depreciation. That is income before tax. Now tax is 40%. 40% of 16,000 is $6,668. 40% tax on this amount is that much tax, so we calculate the tax for all 4th year. Now this is income after taxes. We will add back this depreciation in order to get the cash flow. So 33,000 is initial incremental cash flow, 36,000 for the second year, 28,000 for the third, 26,075 075 is incremental cash flow for the 4th year. This is our incremental cash flow. For cash flow, we will add back non-cash item. Moving further, incremental cash flow for the terminal year cash flow. So for the 4th year, in the previous slides, that is incremental cash flow for the year 4. Salvage value of the machine was given in example was 10,000. Now there is 40% tax. The company will pay 40% tax on this 10,000. So it is 4,000 tax. So it will be deducted from this one. Net working is the project ends. Net working capital will decrease by 5,000. It will be vanished out. So this 5,000 will be added back. So 26,000 plus 10,000, 36,000, then 5 minus 4,000, then plus 5,000. It is $37,075 terminal year net cash flow for this project. Summary of net cash flow. At the initial year, the company incurred 75,000 cash outflow, that is negative. So because the company is going to pay that much amount to the outsider. In first year, the company will receive $33,332 cash flow in first year. Then in the second year, the company will get $36,446 cash flow in the second year. In third year, the company experiences a cash inflow of $28,146. In terminal year, the company experiences a cash flow of $37,075 per year. So that is the cash flow pattern of this weaving machines. Why it is negative cash flow? As we calculate, it is initial cash outflow, because this sign is because of this negative cash outflow. This is all about today's lecture. Thank you.